Hello and welcome back. This is Chez Guevarra video number 5, and we are going to be talking about the calculation of free cash flow. So far we have completed a series of inputs that are our assumptions about the future. We've been able to complete the income statement forecast, and we've completed the balance sheet forecast. And let's just notice a few things here about the balance sheet forecast. The value of the assets is obviously growing up until year 2021. It declines in year 2022 because it's being depreciated and we are no longer investing new capex. Also notice how as we do more and more sales, so our debtors gets higher. It looks like our inventory numbers get higher and higher, more cafes, more inventory required. And as our revenue increases, so does our cash on hand increase. So those numbers intuitively make sense. It turns out as we are buying more and more raw materials, mostly coffee beans in this case, from our suppliers, well, our creditors are increasing. We owe our suppliers more and more money. And even though it might be more and more money that we owe them, what is consistent here is that we pay them on 45 days. The overdraft increases as we spend this money on capex, the 900,000 per cafe, and you'll notice that in 2021 we see the peak of our capex requirement there at a little over, or I should say a little under if you want, 6 million rand required. And then notice in the following year how it drops off quite sharply. Obviously now no longer spending capex to build cafes, and now we are producing profits and generating cash, and therefore the debt requirement is improving or reducing quite substantially. Okay, so that's just a look forward at what is happening. Just for completeness sake, the retained earnings number is growing and growing, and then growing quite sharply in 2022. As you can see, all these profits from now, however many cafes are generating revenues, 22 of these cafes, nice profitability flowing into the income statement. Now, in the valuation process, we ask ourselves, well, where is the value in this business? And the business has assets now. It has these cafes that are producing profits and cash. But what we want to do is we want to quantify what is the cash that's being produced by this business that is not required by the business in order to sustain its existing operations and invest in new operations or new assets. All right, and we call that the free cash flow. So free is not a representation of the fact that it has no cost. Free in this case is that it's not required by the business, therefore it can be freed up or it can be released from the business if you want. In a free cash flow calculation, we are really going to have a look at what is the consumption of cash in the business that's required for fixed assets and for working capital. So when we look at the calculation, there are different ways of doing free cash flow. I'm just going to go with the method that I've used here for now rather than talking through the different methods. Keep it simple for now. The first number that we use is the net operating profit after tax. In other words, what is the profit that is being made by the operations of the business less the tax that is required to be paid on this business? So if we look at this NOPAT number, we would come back to the income statement and we would come here and we'd say, well, here's the operating profit. This is 1.4 million. Let's make an adjustment for the tax component, subtract out the tax if you want, and what we're going to effectively end up at is the profit after tax number. So that works out quite nicely here because there's no interest expense. So the maths works out quite simply. You'll see it's a little bit different as we move on. So 1008,000, or just over R1 million, is the NOPAT number for the first year. Now to calculate the profit over here, back to this number, the 1.4 million, we subtracted out the depreciation, and depreciation is what we refer to as a non-cash expense. So it's not actually cash that is being paid out to anyone. So therefore we need to make an adjustment to say, well, what if we didn't deduct this because we didn't actually pay it? What then would the cash flow be? So that's why we are adding back the depreciation. That's the adjustment for non-cash. All right, so the next step is to go and see what is the change in the current assets excluding the cash component. So why are we looking for the change in the current assets? Well, effectively here what we're looking for is to see, is the debtors and inventory, just those components, is it increasing or decreasing? The principle is if debtors is going up, then cash is going down. And if inventory is going up, then cash is going down. So really what I'm coming here to do is to sum up those two, sum up these two, and get the difference between the two to find out if this has a positive or negative cash flow effect on the business. Now what you can see here from these two is, if we look at them independently, is the debtors is going down. Therefore that's going to be cash positive for the business. The inventory is going up. That is going to be cash negative for the business. But the net result here, mostly because the debtors has declined, is that this is cash positive. So you can see that that number there is a positive number, which is representing a cash inflow, because again our debtors declined. Why am I excluding cash? Because the point of the cash flow or the free cash flow calculation is to determine what is happening to the change in cash. So we don't want to take this into account when we calculate the working capital, because that is the end product of this calculation. Okay, so let's move on to the next component, the change in the current liabilities, excluding the overdraft. So in this case there's no overdraft for those 2 years, but there definitely is a change in the creditors. And here what's happening is the creditors is going up. This is in fact working in our favor from a cash flow point of view. Why is the creditors going up? Because we are buying more supplies from our suppliers, and therefore we owe them more. And this is benefiting us from a cash flow point of view to the tune of 69 odd thousand rand and some change, which is the difference between those two. So that's cash positive. All right, next up, what is the change in the fixed assets, property, plant and equipment? So it turns out that in the 2017 year there was no money spent on new assets. There was no capex investment. So there's no change to that number. Now going forward, that is going to be quite different, and I'll show you how that changes in a moment, because we're going to be spending a whole lot of money fixing out or fitting out these cafes. All right, so now my calculation here for the free cash flow is simply to go and add up all these numbers above. All right, so I've structured my free cash flow so that the sign at the front of the number represents whether it's cash in or cash out. All right, so add all those up, and it turns out that in 2017 the free cash flow was 1.9 million and some change. That is historical. That is before our current point in time, which is 2018. So let's spend a moment looking at the free cash flow for 2018. We're going to get a very different picture. So to start off with, our net operating profit here is -40. So that's an outflow. we're going to add back the depreciation. That's going to work in our favor. The change in the current assets is the change in these two over here. So notice what's happening. Debtors is going up. That's bad for cash flow. I should say negative rather. It's an outflow. Inventory unchanged. And the reason why this inventory number is unchanged is because the cost of sales hasn't changed. What has changed here for the debtors, just to clarify, even though the sales hasn't changed, what's happened is the terms have changed. We're now using these 30-day debtor terms, and what was probably the case in the previous year is the debtor terms were slightly different. All right. So what's happening is there's an outflow of cash in terms of these current assets to the tune of negative 54,000 Rand and some change. Okay, there's no change here to the creditors, so hence no effect on the cash flow. Then for the capex, well, there are 3 cafes at 900,000, and that is an outflow, so that is negative. Then my sum here is I sum those all up, and it turns out that in 2018 there is a free cash flow that is substantially negative, largely due to the loss and the amount of capex that we are spending. So let's look forward here to the following years. Now, if you have your numbers all set up here and you've got your formulas sorted, you should just be able to copy and paste this right, and you will get your future cash flows. So let's just take a look at what's happening. The NOPAT is increasing into the future as more and more cafes come online and we start making some profitability that come from the operations. All right, let's just test this number and see how it's calculated. And simply what I'm doing is I'm taking the operating profit and I'm subtracting out the tax component, and that gives us this number. We're adding back the depreciation. Notice how the depreciation gets more and more because we have more and more cafes. Notice how the current assets takes cash out of the business as the debtors and the inventory numbers get higher and higher, but we do get the benefit of the current liabilities increasing into the future because we are buying more and more from the suppliers. And then here's the ongoing capex. In 2022 there's no capex, and notice how all of a sudden the free cash flow turns very positive in 2022, whereas here it's negative because we are spending all this money investing in the project. Alright, so now what we have is we have a future of free cash flows that has been determined up until 2022. Our forecasting at this stage is mostly complete. What we still need to do in terms of our forecasting is we need to calculate a terminal value. In other words, what is a representation of the free cash flows for the years from 2023 onwards, because hopefully our business will last longer than the year 2022. So in the next video we will talk about that calculation of terminal value and what it means. See you in the next one.